Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Amir Noor, who is the Director of Financial Planning at United Financial Planning Group. Amir, how you doing?
I'm doing all right today. Weather's beautiful today. It's been raining all week, so I'm glad to see a little sun.
Yeah, I got you. I got you. We had some rain come through Austin this morning, but it's beautiful outside right now as well. So I always got to like a good day. And we're excited to have you on the show, excited to jump in and hear a bit more about you. And that's exactly where we'd like to start. So if you could just jump into your story, what brought you into the financial space, and tell us a little bit about your firm, that'd be great.
Yeah, sure. So I've been in financial services really my whole life. I started off as an assistant to a insurance-based advisor when I was 16 years old. I used to go after school and on the weekends. And then as soon as I turned like 18 or 19, he said, "All right, you should get licensed. You can like go get clients." I was based on nothing. He just thought I was good at talking to people. So then I started getting my insurance licensure. Then I got my Series 7. I actually got my Series 7 before I got my bachelor's degree. Um, and then, I was in the insurance broker dealer space for a while, did a lot of work on cash flow planning, risk management, protection insurance, which then parlayed into really high end estate planning, using trust funds and insurance products to minimize and tackle inheritance and estate taxes. And then that also then parlayed to a lot of those people who own businesses into spending a lot of time in qualified retirement plans, which is its own complex beast. In that process, I became more and more frustrated being a commissioned advisor. So I pivoted over to United, where I am now, to do fee only financial planning. So, we do a one time financial plan, an hourly financial plan. We'll do assets under management, but only as a percentage, no referrals, no commissions, no kickbacks, or we'll do financial planning as a subscription.
Okay. Okay. And so what was it just the product you had to push that kind of had you sick of the commission only business or the commission business? Talk to us a bit about that.
Yeah, so there's that inherent conflict of interest piece that you can sign as many waivers and disclosures as you want. First of all, the client's not reading it, and it definitely colors your advice. You know, like how much does the client need it? How much is it in their best interest? Um, and that was frustrating. And then the worst was if the client needed it, the client wanted it, it wasn't the client's best interest, but for whatever reason, they were unable to actually make the product purchase. So we saw that in sometimes the annuity space because of what state they lived in. We saw that in the life insurance space because maybe they were diabetic or something and they physically couldn't get it and they had to do something else.
Yeah. Yeah. No, absolutely. That makes a lot of sense. And so commission only business, kind of broker dealer, that's where you started.
Yep.
That's where you were when you were 16 too, right? Somebody in that.
Yeah, basically. Yeah.
Yeah. Okay. And as your career evolved, you moved to the fee only side of the business to protect that kind of fiduciary responsibility and just
Exactly.
really act in the best interest of the client. And that has led you to a lot of estate planning and then qualified retirement plans. Is that right?
That's correct. Yeah.
Okay. Okay. And so qualified retirement plans, mentioned some of the complexity there. Dive into it a little bit for us because we have some, entrepreneurs who own businesses that listen to the show and
Yeah. So, qualified retirement plans, they're their own beast. And a lot of it is really based on what are the things that are governing you, right? So obviously, if you have an employee, you have to pay overtime if you're paying them hourly, right? You can't fire a young woman because she is pregnant, right? That can't be the reason that you fire someone. People are entitled to take their vacation days. If you violate one of those things, you're violating labor laws. And labor laws, the Department of Labor, they really come after you. So similarly, if you're paying someone, $100,000 a year, and they say to you optionally, "Hey, boss, I appreciate it, but I want you to pay me 10% less. Take 10% of my salary, take 10% of my paycheck, put it in my 401k for me." Well, you have a fiduciary obligation because now you're not holding your own money anymore. It's seen as you're holding somebody else's money, and you take on liability in that process, and you have to do that really, really well. So there's a I think it's 7 days. So when you run payroll on a Friday, you have until the next Friday to make sure that that guy's money, that employee's money, is in their 401k. Sometimes that's done by itself by way of data feeds, right? But if you're a smaller employer, which is the majority of America, right? Uh, you probably have a manual process. Maybe you have to mail a check. You have to do that within 7 days, or else you are considered making the deposit late. You then have to reimburse that employee not only the money that you didn't put in, you have to put it in because it's their money anyway, but the missed opportunity cost of their money not being invested.
I see. Yeah, that does add a level of complexity, especially considering, small businesses are still
Yeah,
primary kind of driver and a lot of people have them and they would
yeah,
be doing that manual process.
yeah. And when you get over 100 employees, you're considered a large business, right? You have over 100 employees, you have to give them health insurance, you have to give them 401k, you got to do these audits. There's all this infrastructure that you have to have. Probably if you have 100 employees, you have a CFO or you have like a chief of HR, you have some of that stuff. When you could have 50 employees, that's still a pretty big business. There are fintech companies that manage millions and billions of dollars. They have like 23 people.
Yeah.
They're less than 50. So like these are arguably large organizations where the owner doesn't realize they're taking on liability. And I think a lot of people they understand like if your phone blows up in your hand, you can go after Samsung or Apple or whomever, but you can't go after the factory worker or even the CEO or the majority shareholder, right? There's a separation between the business and then the owner of the business in terms of who takes on the liability. In the 401k space, that goes away. The owner of the firm or the fiduciary of the plan, whoever's signing the 5500 for that 401k, the responsible plan administrator takes personal liability.
Mm, yeah. Yeah. And I don't know how well I've really this may be the second time I've heard it and I've never heard it to this depth. And I don't
Yeah.
know how well people who are taking on that responsibility know that that's exactly what they're
Yeah.
doing. So,
I think it's one of those things where a lot of businesses and people in general, I think, they need to do financial planning. They need to look at their finances, they need to invest, they need to do these things, but they're not actively and proactively seeking out that guidance. I think a lot of people have this thing where like they need to be able to handle their finances on their own, which doesn't make sense to me. It's no other profession are people doing that, right? Like you call a plumber. Why are you going to try to figure it out yourself, right? Um, but you should call a financial advisor, do that. But what happens is 401ks, like life insurance, like other things, people know they need it, but they don't go search it. So then what does that mean? It means it's sold to them. So if you look at the average household, like how much life insurance do they have? And it's probably a relatively round number 500,000, 250,000, a million, 2 million, one time salary. Why? Because it's sold to them and that's an easy thing to sell. Very few people are going to have the exact, you know, $1.345 million to replace X number of dollars of income plus their mortgage. That's not how people buy life insurance because they're not doing an analysis, figuring out what they need, and then being proactive about it. It's sold to them, and then they're like, oh, yeah, okay, I need it. And then they do it. Similarly, 401k plans are sold to business owners. It's not the number one thing that they're excited about in their business.
that makes so much sense. Why do you think it's
Yeah.
like that? That kind of dissonance of people don't want to call financial professionals has it just gotten a bad rap because of the commission only side of the business or other reasons people just think they're all financial geniuses or
Yeah, I think there's so much to it. I think there's like a personal pride element, right? Which you alluded to in that, like, they feel like they should be able to do it. There's also this whole notion of like it's taboo. You're not supposed to talk about it. Um, and also, it's very new. People didn't have to do that for a long time because you would have pensions. The 401k was invented in something like 1978. And so that means we had pensions during the moon landing. We went to the moon in 1969 and we had the 401k almost 10 years later. So during that whole window of time, these people were doing their jobs. The average American was living their life. They were working there for their employer, and they had some form of either when we were agriculturally based as a country, you worked till you died and you lived on the farm and whatever. But this whole notion of personal responsibility of your personal finances is arguably a new concept.
Yeah.
And so you're being raised from your parents or your grandparents who never had to have it and have horrible opinions about what you're supposed to do with money because they didn't have to do it.
That makes a lot of sense. Makes a lot of sense. And so, talk to us a little bit about where you go to stay up to date with the kind of latest market trends, cutting edge financial strategies to stay on top of it so you can be that professional to help your clients.
Yeah, I am doing so much CE. CE is continuing education. So for all the various licensure that I have, I'm certified financial planner, CFP. I have to do continuing education credits. I'm a member of NAPFA, National Association of Personal Financial Advisors. They actually double the requirement for their members. So instead of 30 credit hours every 2 years, I have to do 60. And then on top of that, I'm in the process of becoming an enrolled agent with the IRS, which is 72 credit hours every 3 years. So that's the number one way, right? I'm trying to get my credit hours to maintain my accreditations, my certifications, and my licensure. And then I'm just always reading. I never want to be in a position where somebody's asking me a question and I manage their money, and they're like, "Oh, what about this that happened, in the news? How does that affect my portfolio?" And I have no idea what they're talking about. So I'm always trying to keep a pulse on what's going on in the world. My wife hates it because I'm always reading something on my phone. She's like, "Hello, we're having dinner."
Yeah. Yeah. No, absolutely. It's good for the clients, and I can see how it annoys the wife, but it is it is important to stay informed so that you can protect your clients and those continuing education. Talk to us a little bit about an enrolled agent for those who don't know exactly what it is or what you would be doing.
Sure. So an enrolled agent is the highest credential that's offered by the IRS. So you're enrolled to practice before the IRS and represent clients in front of the IRS. So that could be responding to letters, filing tax returns, doing tax planning, things of that nature. If anyone's ever been to a networking event or a BNI, or unfortunately you've just been stuck watching the movie Groundhog Day and you see a life insurance agent or those combination life insurance agents slash financial advisors, you'll see on their business card somewhere on the bottom a disclosure that says something to the effect of, "This is not tax or legal advice. Consult your tax advisor." Even though they might give you arguably tax advice, like put money in a Roth IRA. Well, that's tax advice. Or like a 401k, section 401, subsection K of the tax code. Well, that's tax advice. Doing a Roth conversion, that's tax advice. Put your house in a trust or don't put your house in a trust. That's tax advice. Um, Buy life insurance because the proceeds are tax free for your kids. That's tax advice. Or your investment advisor. Put your kid's college fund in a 529 plan so that it's tax free on the way out. That's tax advice. But then their business card says this is not tax advice, right? Because they're not a tax professional. They don't have the authority to actually put in writing tax advice to you that you could then furnish as evidence to the IRS. Whereas as an enrolled agent, or if someone was a CPA, certified public accountant, they would be authorized to provide tax advice.
Okay. And what's the difference between CPA and enrolled agent? Just the
So
IRS
CPA, certified
designation?
public accountant, is that's actually a state by state registration. So similarly, attorneys, they have to register in each state. You pass the bar and you have to get admitted in each state. Accountants, similarly, they have to be registered in each state that they do business in, and they take the exam to become a CPA in the state that they do business in. My understanding, I'm not a CPA, so I'm not like an expert on that part, but it's 4 exams, and you do 2 exams on audit and then 2 exams on tax. And somewhere in there, there's other stuff about bookkeeping and cash flow statements and financial accounting and corporate accounting and things like that. Whereas the enrolled agent exam is just a tax exam for the IRS, and it's federally recognized because the IRS is a federal authority.
So, long story short, when you become that enrolled agent, are you already are and you're taking the continuing education for it or you're in the
No,
process?
so I took all the exams. I called them. They said I'm going to get it next week.
Okay.
So I don't have the letters yet, but
Yeah.
hopefully next
So
week.
by the time this show is out, all these entrepreneurs
Right.
listening, all these savvy investors who need some tax
Right.
advice, they come to you.
Right. Exactly.
There we go. Well, cool. Let's jump into the current market and your insights on that. Tell us about what factors you feel are most important to pay attention to and then some high level strategy to address them.
Yeah. So the market's been very crazy the past like 18 months. I feel that it's been I used to call it caterpillaring, where like if you take the opening price and then it goes up and down all throughout the day, and one day it's caterpillaring. But it's been doing that over the course of 18 months. It's very up and down, very volatile. But last year we were still up pretty substantially, right? Um, so as I look at the look forward for the market, it's an election year. Election years typically are pretty good, though that doesn't necessarily mean anything because we have geopolitical unrest in the Middle East. We have geopolitical unrest in Russia and Ukraine. We have geopolitical unrest with China and Taiwan. Taiwan is the major manufacturer of our semiconductors and our chips that we use for all of our uh, different technology. And now everything is based on that. So if you look at what's really driving the S&P 500 and the Nasdaq up, it's tech companies. Nvidia is up like crazy, right? And so they need the chips that they get from Taiwan, and so China poses a pretty big risk to Taiwan. Um, Yemen blocked off the Red Sea, which is a major shipping and transport canal, and so that could affect a supply chain issue. So all of those things could, but again, I say could because we don't know what the impact of that's going to be. So what should the average investor do? Whatever their financial advisor told them to do because it's based on your personal scenario, right? A 22-year-old in this market, if they have 10 grand, 20 grand, 100 grand sitting on the sidelines and they're waiting for something to happen, maybe it'll happen, maybe it won't, right? If you're 75 years old, you shouldn't care about any of this. You should have been in 30-year bonds and you're just living off your interest.
Yeah. Yeah. No, that makes a lot of sense. And so sounds like the high level strategies both cater to the person, but even kind of your tips for risk would be catered to the person. Because the next question we typically ask is how is all this kind of geopolitical unrest um, influencing your perspective on risk and how to navigate that in the market?
100%. It's about risk, right? And risk is specific and relative to the individual and investor. So, when you go online, if you get all your financial advice online or your investment advice online, it's not catered to you. A 22-year-old with 10 grand and a 45-year-old with three kids and the 70-year-old on fixed income, all of them should be invested differently. So I would consider it bad advice to tell all three of those people, just throw it in index funds,
Yeah.
you know? It should be that risk adjusted portfolio, which maybe is largely comprised of index funds, but in a way where you understand the risk and volatility. Um, for those that are listening in that are more mathematically oriented, risk and volatility is just standard deviation, right? It's the spread, it's the plus or minus. If somebody says it's going to go up 10 plus or minus 8, big spread, right? Something that's less risky maybe is going to be up 3 plus or minus 1. So you want to tighten the spread, even though it gives you a little bit less of a potential return. That is a more conservative investment. The bigger the spread, obviously, the bigger opportunity, but you need to do a risk adjusted analysis to determine how much spread you're willing to take.
Mm. And so I want to hear about specifically, let's talk about two personas because it is all very individual, right? But let's talk about
Yeah.
two personas. Maybe an entrepreneur gearing up an exit and they're going to close it in the next 6 months, right? So they're going to get a
Yep.
huge windfall of cash. And then we have that kind of savvy retiree who doesn't have their plan fully set yet, but maybe they're 63, slightly early retirement, and they're trying to get to a position where they're set. Let's talk to both of their scenarios given this kind of current market environment.
Yeah. So the entrepreneur who sold their business, they're younger, they just got a big windfall of cash. Is the assumption here that it's enough money to set them up for life, or they're going to then parlay that into opening another business?
Um, let's say both. Let's say it could set
Sure.
them up for life, but they also have a hankering for a
Yeah.
new
So
business.
if you're going to be set up for life because of the windfall of selling your business, 100%, right? Diversified mix of stocks and bonds relative to your age. And the number one thing I would tell you is don't focus on the market for a little bit. Focus on your budget and your cash flow because we need to know what your withdrawals are. So if you have $1 million and you're taking out 100 grand a year, that's very different than if you have $1 million and you're trying to take out 40 grand a year to pay
Mm,
your bills,
yeah.
right? So figuring out your budget, I think, is the number one most important thing there, and that will determine how much risk can you really afford to take, right? I think the other thing that happens is younger people. in general have almost this, myself included, right? Like I'm not that old, but I want something and I want it now, right? Like Amazon Prime has spoiled me. If I don't get something in 2 days, I am furious. But like this whole notion of 2 day shipping is not, that's not the norm. I used to order stuff on eBay back in the day and it would take like 21 days to get to me. And I thought that was a great deal. So, there's this, if you're trying to live off of your income and you want to be set for life, are you baking in things like that? Oh, I'm retired, I'm going to travel, or I'm financially free, I'm going to travel, I want to see the world. If it's a bad market year for you, are you okay with saying, I'm going to put it off this year? And a lot of people can't do that. They'll still go anyway. And that's not good, right? So the budget, I think, is key in helping drive what do you do with your portfolio. If someone's going to parlay it into another business, so then you have a couple of options. It depends how much it is. But if you need something immediately, you can't afford for the market to take a dive. So you're probably going to go into some kind of cash or high yield savings, which, by the way, high yield savings right now are incredible. It's like better than they've been in decades. So, like, that's not a bad play. But if you don't need the vast majority of it, you can throw that into the equity markets and maybe it'll be up 20%. That's a home run for you. Maybe it'll go down 20%. But if you're okay with that kind of spread, well, that's great. And if you don't want to then take the tax hit of the gain or the loss, you can use a line of credit against your stocks. I mean, that's what Jeff Bezos does. He has all this Amazon stock. It's worth over $1 trillion. He doesn't sell the stock and pay the capital gains because the profit, the gain that he has in that stock is ridiculous. He started the company in his garage,
Yeah.
right? So the amount of like, what did you spend to acquire the stock versus what is the stock worth now? That's profit, right? That'll be a taxable gain to you. So he doesn't do that. He goes to a bank and he says, "Hey, I have all this stock. Give me a loan." And then that loan is not taxable. He'll use that loan to fund his lifestyle and then pay back the loan from other things. Or and the bank takes the stock as collateral. So if he doesn't pay the bank back, they just arguably foreclose or default on him and just take the stock and sell it.
Yeah. Now I'm curious. Some people might say that's a little bit more risk than they're kind of willing to take on because it's
Yeah,
like, do I want to put my stuff up as collateral and take on debt? I'm a Dave Ramsey. I'm a Dave Ramsey person.
sure. Yeah. So debt is a tool in a toolbox, right? So there's a, if you want to hammer in a nail, right, you can do it a whole bunch of different ways. Take the back of a screwdriver and just jam it in there, right? But you're not using the tool the way it's supposed to be used. So debt is a leverage item. When you're using collateralized assets to leverage debt to then finance a project that will appreciate, that's really good debt, right? So if you take out student loans, that's good debt. Why? It's low interest rate and you're financing the opportunity to get higher income. Using debt to buy real estate. So arguably, the student loan debt that you use to parlay into a higher income is really no different than using a mortgage to buy a rental property. And then instead of a salary, you get rental income. Those are similar types of debt, right? You're leveraging debt to acquire an asset. The asset of the student loan is your degree that gives you your income, your job. The asset for a mortgage is the rental property that gives you rental income. Either way, it's income generated by the purchase of an asset. And you used debt to do it instead of saving up to do it. Um, if you take on debt to go to Cabo or to buy shoes or to buy a car, a depreciating asset or a consumable product or an experience, that's bad debt.
Yeah. Yeah. No, absolutely. Well, I think that's good on the current market. Let's go ahead and jump to alts now. When you're looking at alternative investments in 2024, first, define alts in your mind and kind of how you see them and how people should see them because there's a wide array of alts, right?
Yeah,
It could be a lot of stuff. And then talk to us about how you evaluate alternative investments.
sure. So for alternative asset classes, I think it's important to first understand what's not an alternative, like what's the normal asset classes. So the normal asset classes are going to be stocks, bonds, index funds, ETFs, mutual funds. So the alternative to those are going to be illiquid, kind of harder to acquire assets. Um, so that can be things like hedge funds, that can be REITs, that can be different types of vehicles wherein you're in a pooled investment with other investors as opposed to you physically doing something. pooling assets to go in on a venture, but doing it through an asset manager as opposed to like you and your buddies buying a house and fixing it up and trying to flip it. You're going to a fund that is getting money from a bunch of different investors who then go and try to achieve some yield or outcome through some project that they're doing. And that can be real estate. That's where I see a lot of it. It can be private notes. I've seen that a lot in the alternative space. Something that I think is really interesting in the alt space right now is data centers. So I'm seeing firms where they're buying these big server farms and these huge warehouses as data centers, where the tenant of the building is T-Mobile, is AT&T. They house all of their servers, all their racks in those big warehouses. So from the perspective of the person who owns the warehouse, which in this case is a private fund, so the fund owns this warehouse. They trick it out with the alarm system, the security system, the water cooling you need because all those servers are very hot, all the cabling, all the power, maybe solar panels on the roof. And then they go get a tenant and they put in all their server racks, they put in all their security, they do all that. And then you get this stream of rental income. And then they, on the back end, try to appreciate that asset, sell the entirety of the warehouse to then either another investor, to another real estate group to turn a profit on the back end.
That's interesting, and I don't know how deep you want to go into this, but why aren't the companies like T-Mobile and AT&T just buying the warehouses for themselves? They seem like they would have the
I asked
cash.
them that exact same question. Actually, I was like, "Why isn't T-Mobile just buy the warehouse?
Yeah.
It's T-Mobile." And they said that it actually like it muddies up their balance sheet. Like it's better for them to say like, "Hey, we have this much in profit, and we're putting that back into our telecommunications," as opposed to having to like deal with all the taxation of all this like real estate that they own and depreciate this warehouse. They just want the lease line item expense, and they write off the lease payment.
Man, that is so interesting.
Super interesting because there's obviously some tax benefits in saying, "Hey, I have this asset too," but it actually is this asset that you have to spend the money to maintain that you then can't invest back into your telecommunications.
Yeah. No, that makes a lot of sense. That makes a lot of sense. Well, cool.
Made sense to
Yeah.
me, but
Simple
like,
answer to a
I
simple
listen, I don't
question,
do
I
that.
guess.
Yeah, yeah. There was there's a lot of companies that do similar things where they have all these subsidiary companies. They really like zero in on what they're doing. Um, I mean, you see it in who did this recently? It was Coca Cola. Coca Cola has two separate businesses. They have Coca Cola, the beverage manufacturer, and they have another business that's a bottling company.
Oh, very nice.
Yeah.
Well, cool. So when you're looking at these alts, and let's just take the data centers for example, um, what are you evaluating them based on? Is it like not correlated to the market? Is it the fund manager's experience? Is it the location of the asset? Talk to us about that.
Yeah, all of it. Right. There's no one thing. I often find people want to know, like, oh, what's the one thing? And if it was so easy to make it the one thing, everyone would do it, and it would be a lot easier to just everyone to be wealthy and be profitable. It's not the case. You have to actually look at all of the factors, or as many of them as you can. And I think arguably one of the keys to success in general is looking at is your ability to look at a broad and wide data set and actually assess as much of it as you can. So the person that can assess one or two or three more data points than you is going to do better than you.
Yeah. No, I think that's a good point. Acting on data versus intuition or guessing or
Yeah.
hope is not a strategy, right? Hope is not a
That's actually what I told my younger brother when he was finishing college. I told him um, the key to success is the intersection of doing two things that you either are really good at or you really like. Because if you really like it, you'll ultimately become good at it. But if you're only good at one thing, you'll be a pretty good employee, maybe. But if you're good at two things or you like two things, you'll be phenomenal. So the example is if you wanted to be a doctor and you have an affinity for computer science, and now you have this ability to do biomedical technology coding, where you can be the programmer for these medical robots, you're going to make infinitely more money than the cardiologist.
yeah. No, that is a fantastic example and seems very relevant too. Fantastic and relevant. Yeah. So you evaluate it on everything, trying to gather as many data points as possible, and that's who the fund manager is, background on them, kind of whole
Yep,
underwriting on the fund manager, whole underwriting on the opportunity, whole underwriting on the actual finances of the opportunity. But what
correct.
role do these alternative opportunities really play in portfolios when you're constructing them?
Yeah, it's a good question. So for the first things first is that you have to understand what is the end client goal. So for the end client, for a lot of these, you have to be an accredited investor. So you have to already be high net worth to do it. So this is not the type of thing that you're doing if your net worth is $100,000. This is not the type of thing that you're doing um, if you don't have a huge risk appetite, right? Um, that doesn't mean that this is one of those things where this is how the rich get richer. That's not what it is. It's actually the reverse. It's actually there's so much risk involved. As a percentage of your net worth, you shouldn't put a lot into it. So if you have, I'm making it up. Let's say the minimum investment is $1 million, and you have $1 million, you shouldn't put 100% of your net worth into something like this. But if you're worth $100 million and you took $1 million, which is 1% of your net worth, and said, I'm going to throw out this data center thing because maybe I'll get really good returns, or maybe the thing blows up in smoke, or the fund manager embezzles all the money. Who knows? But it's not going to kill me. So it's not a rich get richer thing. It's the reverse. It's protecting people where it's too large of a percentage of their net worth for them to stomach the loss.
Yeah. Yeah, no, that makes a lot of sense. Because when I first learned about the accredited investor thing, I was honestly, I was a little upset. I was like,
Yeah,
I'm learning about all these opportunities, but you're telling me I can't participate, and
yeah,
that's where you get the 25% returns on a private equity deal. Like, I want to be a
right,
part of
right,
that.
right. But the problem is, one of those goes bust. Then what do you do?
Yeah, yeah. Then you're SOL, and you were probably young and over your head, and
Hmm.
that's what
Yeah.
happened. But so you have to be accredited, and that's kind of first and foremost. You're looking at the client goals, always a small piece of the portfolio. And are you going into alts primarily for growth, primarily for income, or primarily for diversification, or just really whatever that client goal is? It's a mix of that. Maybe they just like the investment, and that's why you go in. I'm not sure.
Sometimes they just like the investment, right? Like that's honestly a lot what it is.
Yeah,
They're just like, I want this. Um, Sometimes it's access. Like I've actually gotten clients because for some of these, you actually can't get into it. They won't. You can't just call them up and be like, "Hey, I want to throw $2 million into your fund." They're like, "No, you have to go through an advisor as the intermediary." So I've gotten clients who are just like, "I don't actually want to use you. I just need you to be the guy that signs his name on the form so I can get into this fund." Uh, and then they became actual true blue clients after that. Um, but the thing is that has attractive yields, right? So like if a high yield savings account right now is giving you 5%, and now because of the interest rate environment, you can get 1 year treasuries or CDs for 6%. That's really attractive. Or if I forgot who it is, Coca Cola, somebody, maybe it was Tesla, they just did like a 10% dividend. Like, okay, there people are giving out, cash flow. So what's the purpose of the investment? And I think for non technical investors, real estate is a good example because people kind of get that. So you can buy a house and you can flip it, or you buy a house and you hold it and you collect rental income. It's very similar when you're investing. Are you buying investments, whether it's stocks or bonds or index funds or alternatives, to generate yield, or for that underlying asset to appreciate in value so that when you sell it, you've ultimately made a profit? You're a flipper or you're a renter, right? You're a landlord. So some of these alternatives, like the data center one, they're trying to maximize both. Um, and so because you're doing two things, obviously that's higher risk because you're not specializing in one. If it hits, awesome, you know. But if it doesn't hit, it can totally go to zero,
yeah, yeah.
right?
No, that makes
Uh,
a lot of sense.
that's kind of the underpinning of it. So with a lot of stocks, a lot of people buy stocks because of the underlying appreciation. They want to flip the stock at some point in the future. Other stocks people buy because they historically pay out a large dividend to their shareholders. You're the landlord.
Yep.
With bonds, with a high yield savings account, same thing. And I think people don't think about their high yield savings account as the same thing as buying a bond. you're buying a financial product,
Yeah.
right? So you're buying it for the yield it's generating. You're basically a landlord.
It's a very fair point. Very fair point. And so we talked about data centers, but are there any other alts that you want to learn more about in 2024, or are data centers kind of the one you're focused on?
That one was just very interesting to me. Um, in terms of other alternatives, there are, alternative fund managers that do pretty much any type of investment. They are investing in agriculture. I met someone actually where they're starting up a fund and taking on new investors to buy farmland and ranchers in Montana. It's like a private equity ranch fund where then you get like the agricultural and livestock yield.
Oh, wow. That's interesting.
Yeah, you can buy wineries, you can invest in wineries through like private funds like this. Um, I know someone who's trying to set one up, and I don't know how to do it. So if anyone's listening to this, if you know how to do this, email me. Where he's in Turkey and he's trying to set up a wind farm.
Wow. A wind farm in Turkey.
Yeah,
Huh. I actually know somebody who might. It's not wind farms in Turkey, but he does solar farms internationally. And so there might be similar.
yeah. This guy, he's doing it anyway. He's already like super loaded,
Yeah.
and he's doing it. But then he's like, but if I got investors, I could get a much bigger wind farm.
Hmm. I gotcha. I gotcha. Very cool. Very cool.
Yeah.
Well, man, yeah, there really is a manager out there for basically any alt that you want to
Oh yeah.
invest in. it's a
Yeah.
it's a big space. Well, cool. You're gonna jump to the last section of our show where we come back to your firm. We didn't hear a bunch about United in the beginning, so tell us about how people can tell you guys apart from other financial advisors.
Yeah. So we are, first of all, we're all fee only at the firm. It's a full fee only firm. So we're fee only, no commissions, no referral fees, no kickbacks. We are completely acting in your best interest. Every advisor at the firm is a certified financial planner. Um, and also, we're an accounting firm. So we have CPAs and enrolled agents at the firm as well. So, depending on the client's needs, we can do the tax advice, we can do the tax return. Right now, it's tax season, we're doing returns. It's the worst. We can do assets under management. We can manage your portfolio. Or you can say, you know what, I don't want to pay a management fee. I can go to Vanguard and do it myself, but I want to pay you for your time and your advice and your expertise. We can do that too. And we're New York based. So we have that New York energy. And I think the number one thing that we do that, which is odd to me that not everybody does this, is we guarantee that we will respond to your email within 24 hours.
Mm, that's a big deal.
Yeah, I just got a client who like took a week to get an email back. Uh, and that was the most. I was like, isn't that normal that you just reply to people's emails right away or as soon as you can, or at least say like, "Hey, I'm working on it. I have to do more research on this."
Yeah. Yeah. I mean, no, it's not.
I thought that's just how you do business.
Yeah, I mean, it's how you do good business, but it's not how all
Yeah,
business is done, right? Very cool. And what do you think is most important to that kind of ideal client advisor relationship?
trust. Trust is number one. Number two is likability, and all of that is built on an underpinning and assumption, which is a bad assumption, but it's an assumption that the person is qualified. So you shouldn't work with an advisor who's not qualified. I personally like to tell people the minimum requirement should be that they're fee only. I think that's kind of the gold standard. They should be a certified financial planner. They should have the CFP letters and accreditation after their name, and they should be a fiduciary, right? If they have that foundation, then it's trust, and you have to like them. If you don't like them, you're not going to listen to their advice.
Yeah, 100%. Well, awesome, Amir. Thanks so much for coming on the show. Is there anything else you feel like we want to talk a little bit more about before we wrap it up?
Yeah, anyone who's listening to the show, I'm going to Ireland and London, and I'm going to Italy this year. I'm using credit card points to do it all, but I need to know what restaurants I need to go to. I'm going to Dublin, I'm going to London, and I'm going to Florence. So if you have a recommendation for a restaurant, I need to know as soon as you can.
There we go. Well, if you guys have recommendations for restaurants, you just liked what Amir had to say, you want to contact him more, where should they go to find you?
So you can go to amirnoor.com, and there you'll just have all my links. You can go to unitedfpg.com for the firm. You can see my YouTube channel at amirsanecdotes.com. Or, I'm sure in the description of this episode, you'll find my information.
There we go. You are spot on. All the links to contact Amir will be down in the show notes. Thank you guys so much for watching. Amir, thank you for coming on the show, and we will see everybody on the next one.